Hello guys, welcome to Bhavna's Online Academy. So in this video, we are going to learn the sums of AS15 and we are going to practice that. In the part 1 of the video, we learned all the concepts and the part 2, we are going to now see all the sums. I'm going to cover all the examples, illustrations as well as your test your knowledge question. So make sure to watch till the end, and if you have not watched the concepts video, I would highly recommend you to do so because the question specific points also I've covered in this. So it's easier for us to solve here. Okay. So now let's start. So starting with illustration number 1. So in illustration number 1, they tell you that what are the kind of employees that are covered in the AS15. You had already read that all kinds of employees are covered in AS. All kinds of employees are covered in AS15 and they may be full-time, part-time, permanent, casually or temporary. Okay. And then they are asking whether a formal employer-employee relationship is it necessary? The answer is no. Okay. It need not meet the definition of a formal employer or employee. See, there is no requirement for a formal employer employee relationship. You just need to see. Okay, now as a written document, it not be formal. Formally, it need not be agreed upon that he is the employer and he is the employee. But if you see that particular work, and if you see the root of it, you will understand that it is an employer employee relationship only. So formally an agreement or something like that is not required, but if you see other factors and everything, no, you will be able to determine the nature of relationship that it is an employer employee relationship only. So that will also be okay, that will also work here. Fine. So here then they are telling you that it should be a contract of service and not a contract for service. In the concept video I told you the difference between both. Contract for services usually comes when a professional service is taken, where the professional who is there, he is not bound to listen to the employer. Whereas in a contract of service, there is an employee employer relationship and the employee is bound to listen to his employer. Okay, so it should always be a contract of service. Fine. So that was your illustration number 1. Next is illustration number 2. In illustration number 2, they tell you that whether an enterprise is required to provide for employee benefits arising from informal practices. Where is it necessary that they have to, account in their books, or give an employee benefit to the employee if it's coming out of informal practices? Like I told you one example in my concept video, no, the Diwali bonus they are giving for last 50 years in their company. So the employees, what they will think that this year too they will get this employee bonus. Okay, sorry, this year too they will get their Diwali bonus, correct? So here that's what they have said, that informal practices give rise to an obligation, that something you have been doing for so long, the employees will expect that this year also you will do it for them. Okay, so here then in such case you will have no other alternative but you have to pay for that employee benefits. It is depending on the historical pattern, like for the last 50 years you have been doing so, like that. So an expectation gets created in the minds of the employee. Okay. And here, for example, they are saying that when an employer has a practice of making a lump sum payment on the occasion of a festival or regularly grants advances, it would become necessary to provide such benefits. If it has been doing so, then they will have to do it. But here they are saying that you can also use your judgment whether it is an obligation or whether they need not do it. Okay. So let me show you one line here. They are saying, see, if the employer has not set a pattern, if the employer has not set a pattern about reliably giving that obligation or giving that employee benefit, then no requirement to provide for the benefit. If they have made it like a yearly thing, or if they have made it like a practice, then they will need to give. But if they have not set any pattern, then they need not give. I hope you understood the answer to the question, whether they will have to provide for employee benefits arising out of informal practices. If the employee has made an expectation in his mind due to a pattern, they will have to give it. So that was your illustration number 2. Now coming on to illustration number 3, where they tell you that there is an entity Y and they are required to pay a salary of 2 crore for the year 2001 2002. They will have to pay a salary of 2 crore. They have only paid, so they have actually only paid 1.9 crore up to 31st March. So they are yet to pay another 10 lakh rupees. Another 10 lakh rupees they are yet to pay, correct? So 0.1 crore they are yet to pay. So here What is this? This is a liability to the company. This is a liability to the company. This is a salary outstanding. This is a salary outstanding. The company is yet to pay this. So during the year, what entry you will pass? You will pass employee benefit expense account debit to bank account. To bank account. How much have you paid using bank? You have paid 1.9 crore and 1.9 crore. Then I told you in the concept video that one more entry you will pass where the salary has been accrued, that the employees has worked for the year but the company has not paid it. So second entry will be for accrued but not paid. So for that, what will be the entry? It is going to be again employee benefit expense account debit. Two, you will create a liability which is to salary outstanding account. Here you will put zero point 0.1 crore, zero point 0.1 crore. So here how much will be your total expense? Your expense will be employee benefit expense 1.9 crore, employee benefit expenses 1 crore, sorry, zero point 0.1 crore. So 2 crore totally will be your expense. But how much will be your liability which is unpaid? It is going to be zero point 0.1 crore, or what we know call as 10 lakhs. Okay. So I hope you understood this illustration. This is also the journal entries are covered in your concept notes. You can refer to that. Fine. Now let's move on to an example where they tell that enterprise has 100 employees. Okay, and they are entitled to 5 working days of leave each year. Fine. Unused leave, whatever is there, it may be carried forward for one calendar year. That means for 1 year they can carry forward that leave. And they are saying the leave is first taken out of the current year's entitlement and then out of any balance brought forward. So here what they're trying to say is, suppose from the last year they have, so in suppose 2001, they had how many days of leave? 5 days of leave, and the employee only took 3 days of leave. So remaining how much unused leave balance is there in the last year? 2 days of leave balance is there. Now this will be carried forward to the next year. For 1 year it can be carried forward, so it is going to get carried forward to the next year. 2 days of leave balance you will have already, which is carried forward from the previous year, and fresh you will get another 5 days of leave. So totally 7 days of leave balance you will have in the current year. In the current year you will have 7 days of leave balance. Now, if an employee is going to take, suppose, 6 days of leave. Now, suppose if the employee is going to take 6 days of leave, here they are telling you that the company is following something known as LIFO method. First, whatever current year leave balance is that, they will exhaust that. Then only they will use the unused leave balance which has been brought forward. So, here current year how much? 5 is there. So when you are exhausting the 6 days of leave, first this 5 days of leave will get out. So remaining 1 day of leave you will have. That how will you set off? That you will set off from this carry forward leave. So 1 will go and 0. So when you see at the year end, you will be left with one leave, one unused leave balance of previous year, one unused leave balance of previous year. Now here what is the negative? What is the negative impact here? I told you in the concept video also. So here what will happen, since this two leaves you were only able to carry forward for 1 year, and even after carry forwarding still one leave balance is left, because only one you were able to set off, so still one leave balance is left. This will go in waste, because in 2002 itself you had to exhaust it completely. Now 2002 you were not able to exhaust, so this will not get carry forward to 2003. So this leave will get waste. But now suppose, imagine in 2002 you had 2 and 5. 2 was a carry forward leave and 5 was a fresh leave, and there was a total 7-day leave balance. And what the company said was, we'll use FIFO method. That means first previous year balance we'll set off, and then current year balance we'll set off. And if the employee took 6 days of leave, then first what would happen? First this 2 days of balance will get over. Then from this 5 days, more 4 days of balance will get over, and like that 6 days of balance will come. So now here how much is left? In your fresh leaves, 1 day of balance is still left. 1 day of leave balance is still left. So this 1 day which is of the current year will get carry forward to the next year also. Okay, this fresh leave of 1 day will get carry forward to next year also as an unused leave. But in LIFO method what happened? In LIFO method, because you are first utilizing the fresh leaves and then the carry forward leaves, so the carry forward leaves can only be carried forward for 1 year. So even though the leave balance is left there, you will still not be able to carry forward to the next year. So that leave will get wasted. So that leave will get completely lapsed and wasted. I hope you understood this. Okay, fine. So now let's read what's given further. So they are saying that at 31st December 2004, the average unused entitlement is 2 days per employee. So 2 days per employee is left. So let's write the facts here. Okay, so they are saying that there are 100 employees and 5 days of paid leave or compensated absences they are getting, and they are using something known as what, LIFO method. Okay, and then they are telling you that 2 days of unused leave balance is there. That means 2 days of leave balance they have brought in, they have carried forward and brought it in. Okay, they brought forward, fine. And the enterprise is expecting that based on the past experience, it is expected that 92 employees will take no more than 5 days of leave in 2005. Okay, so here they are telling that at the next, so that amongst this, yes, so amongst this 100 employees in the current year, only 92 employees will take leave. Okay, and that also they will not take it more than 5 days. Maximum only 5 days of leave they are going to take. Okay, and the remaining 8 employees which are there. So from this, the remaining 8 employees who are there, they will take an average of 6.5 days of leave. So they are going to take 6.5 days of leave. Okay, I hope you understood this. Fine. So here what happens is, now when you see this, the 92 employees who are there who are going to take 5 days of leave. So here what happens, they totally have all employees, these 100 employees are totally how much balance, 5 days of current year leave plus 2 days of carry forward leave, 7 days of leave they have. So this 92 employees will only take 5 days of leave. That means since they are following LIFO method, so all this 5 days they will use it from when? They'll use it from the current year balance itself. So current year balance only they'll exhaust it. So leave this. Now this 8 days, now this 8 employees, they want 6.5 days of leave, out of which 5 days from current year they'll first exhaust, because last in first out. So last they got this 5 days of current year leave, this they'll exhaust. After that, from previous year leave balance they'll exhaust 1.5 days. From previous year of leave balance they'll exhaust 1.5 days. That means from 2 days of carry forward leave, 1.5 days leave they will exhaust. So they'll be remaining with how much? Zero point 0.5 days of leave. So they'll be remaining with how much? 0.5 days of leave which has been carried forward. Okay, so here you can see, so the enterprise expects that it will pay an additional 12 days of pay. That means from the previous year, how much leave are you using? 1.5 days of leave. How many employees are using it? 8 employees. So 8 into 1.5 days, which comes up to 12 days. 8 employees will take each 8. There are 8 employees. Sorry, there are 8 employees, and each employee will take 1.5 days of leave. So totally 12 days of leave they are going to take in the current year, which is belonging to previous year. They are going to take it in the current year. Correct? Yes. So the entity, so the answer here is the entity expects that an additional 12 days of pay they will have to pay. Correct. Therefore, the enterprise will recognize a liability equal to 12 days of pay. So I thought you right at the year end. At the year end, what you have to do? So at 31st December 2004. So at 31st December 2004, when the entity is making the books, okay, they will say that next year there are going to be 8 employees who is going to take 1.5 days of leave from the leave balance. So 12 days of leaves I will have to pay them extra in the next year. So today itself I will create a provision related to this. So today itself I'll create a liability provision related to this provision for compensated absences, so that in the next year I'll use this provision to pay off the expenses. Okay, so this is what they are saying, that they'll recognize a liability means they'll create a provision as at 31st December 2004, that equal to 12 days of pay, that they are expecting that in the next year these 8 employees will use this 1.5 days alone. Okay, I hope you understood this. Fine. Next we are going to see the next example. So where they tell you that there is a profit sharing plan, and they are going to pay a specified proportion of its net profit for the year for the employees who are going to serve throughout the year. Okay, if no employees leave during the year, the total profit sharing payments is 3%. If nobody leaves, if all the employees stay from start till the end, they'll have to pay 3% of net profit. Okay, the enterprise estimate that the staff turnover will reduce and the payments to 2.5% of net profit. So here they are telling that what will happen is, If the employees serve throughout the year, all the employees inclusive, they will have to pay 3% of net profit. But here they are saying there'll be staff turnover. That means a few employees will leave the organization, and because of that, only 2.5% of net profit they will have to pay. So how much liability will they have to create? How much liability will they have to create in profit sharing plan? I told you that you have to multiply how many employees, number of employees you are going to stay, multiplied by what will be the expected payout percentage. So here they are expecting only 2.5%. So 2.5% of net profit only they'll have to create a liability, or what we call as a provision. Provision of bonus, so that they can pay it out by the year end. Fine. I hope you understood this. Now next is illustration number 4. Illustration number 4, they are telling whether an entitlement to earned leave which can be carried forward to future is a short term employee benefit or a long term employee benefit. Okay, so here you have to see when does it fall due. If it falls due within 12 months after the end of the period, that means it is going to be a short term compensated absences. If it is going to be after 12 months from the end of the year, it is going to be a long term compensated absences. Okay, so let's move on to the next illustration, which is illustration number 5. Here they tell you that an enterprise allows unutilized employee benefits, medical care, leave, etc., to be carry forward. Okay, whether is it required to recognize a provision in respect of the carry forward benefits? So here they are going to carry forward few medical leave, leave travel, etc. So these are unutilized employee benefits, and they are going to carry forward it. So for this, do they need to recognize a provision? The answer is yes. A provision needs to be recognized for all benefits, whether it is conditional or unconditional. For all benefits, they will have to create a provision. So here the answer is yes, they will have to do it. Okay, when you're creating a provision, remember to use the probability, that how much employee will avail the benefit, that expected percentage also you see, and then create the provision. Okay, next is illustration number 6. So here they are saying that there is Omega Limited and it belongs to engineering industry. The company received an actuarial valuation for the first time. For its pension scheme, they have received some actuarial valuation where they have revealed a surplus of 6 lakh rupees. Okay. It wants to spread the same over next 2 years. So here first let me tell you that when they did their actuarial valuation, they received related to their pension scheme. I have taught you about defined benefit obligation, where I taught you about actuarial gain or loss, and I told you, not actual, actuarial gain or loss, where I told you that due to some change in assumptions, sometimes what happens is that you may have either a gain or loss due to it. So here that's what they are saying. When they did that actuarial valuation, it revealed a surplus of 6 lakh rupees. That means there was an actuarial gain of 6 lakh rupees. And what was the entry I told you for this actuarial gain? So because of actuarial gain, what will happen? Your liability will get decreased. So your liability will get decreased. So DBO account debit, your liability gets decreased here to actuarial gain. Actuarial gain, and this is going to go into your PNL account. Okay, as employee benefit expense. Under employee benefit expense, it will go under PNL account. Okay, so this was your journal entry. So here they are saying that it wants to spread the same over. It wants to spread the same over next 2 years by reducing the annual contribution to 2 lakhs instead of 5 lakh rupees. So here what they are saying, instead of directly putting it into the PNL account, instead of directly charging into PNL account, what I'm going to do is this 6 lakh rupees, I'm going to spread it over 2 years, year 1, year 2. So per year 3 lakh rupees I'm going to spread it. And what I usually do is in that particular plan, what I do is I usually contribute. So in this particular plan, I usually contribute 5 lakh rupees. Now what I'll do is, instead of contributing 5 lakh rupees, I'll only contribute 2 lakh rupees each year. Okay, anyway, because 6 lakh rupees I've earned more, so 5 lakh I need not contribute. I'll only contribute 2 lakh rupees. Okay, and then they are saying that the average remaining life of the employee is estimated to be 6 years. You are required to advise. So here you have to tell that this is a wrong approach. You cannot defer. You cannot defer it. You will have to charge it in your PNL then and there. The actual gain you are getting, you have to charge it into the PNL then and there. Okay. So here the employee benefits or actual gain and losses should be recognized immediately in the statement of profit and loss account. We have to immediately charge it in the profit and loss account as income or expense. So the surplus amount of 6 lakh is required to be credited to the profit and loss statement in the current year itself. You should not defer it like this. Okay, I hope you understood this. So yes, so now let's start with illustration number 7. So in illustration number 7, they are saying that on 1st April 2001, the fair value of the plan assets is 1 lakh rupees. That means the opening balance of the plan assets is 1 lakh rupees. And then they are saying that the plan paid out benefits of 19,000 and received an inward contribution of 49,000. So they paid out 19,000 rupees and they contributed 49,000 rupees towards the plan assets. And on 31st March 2002, which means at the end of the year, this means this is the closing balance. Here they are saying that the fair value of the plan assets was 1,50,000 and present value was 1,47,920. So I told you when I was teaching the concept video itself, you should not consider the present value. You have to take the fair value of the closing balance. So the closing balance fair value is 1,50,000, and then they are telling it that there are actuarial losses on the obligations were 600 rupees. So actuarial loss you had of 600 rupees. Okay. Then on 1st April 2001, that means when there was opening date, the company also made few estimates. When they made the estimate, they understood that the expected rate of return is 10.25%. Okay. So these are all extra information. You just need to concentrate on what is the expected rate of return. They are telling you that you have to find out the expected return and annual return on plan assets, actual return on plan assets. Okay. So here first, let's find out what is the expected return. So for expected return, what did I tell you? I told you that you have to do like this. First, you have to take first 6 months how much it will be, second 6 months how much it will be, and then so before doing that, let me tell you that this is the opening balance on 1st April, and this benefit was paid and the inward. Yes. So this benefit was paid and the inward contribution. This all was done on 30th September. That means after 6 months. In our book, all sums are done like this only. Okay. So opening there was a balance, and after 6 months, some balance got up, some balance got down, and then finally the closing came. Okay. So first now you have to calculate that during this period what was the return. During this period, what was the return in the investment. So what is basically plan assets? Like I told you, this is an investment to the company. So in this investment, how much have we earned? We have to see. Okay, so on the first 1 lakh rupees, we would have earned for this 1 lakh rupees was there from opening till the end. It was there from opening till the end, correct? So on this entire 1 lakh rupees, we would have earned this much. How much? We would have earned the 10.25%. We would have earned 10.25%. Okay, and then on this benefits pay that is on this benefits of 19,000 we paid out, and contribution we made 49,000. So 49,000 minus 19,000, 49,000 we contributed, 19,000 we took out from it after 6 months. So 30,000 rupees you would have earned for 6 months. On this you would have earned the return for 6 month rupees, whereas on the 1 lakh you would have earned for 1 year. Okay, I hope you understood until now. Fine. So this is how they have computed the expected return. So on the 1 lakh rupees which was opening balance, which they held for 12 months, they earned 10.25%, which is the same expected rate of return given there. Okay. And then on the rest 30,000, that means after 6 months 49,000 they put as investment, and out of that investment again 19,000 they took out. So 30,000 was the balance. So in this 30,000 balance, which they held for 6 months, they had earned a, what do you say, they earned a return of 5%. Now how did we come at this 5%? If we do 10.25% into 6 by 12, if we calculate it, if we divide it by 2, that means for 6 months, if we find out, this is a per annum rate. So 6 months rate, if we find out, it will come up to 5.125%. But here they have written 5%. How is it? So now remember what I told you in the concept lecture. So this is a compounded rate. This is a compounded rate, compounded 6 monthly. So what you have to do is you have to find out the 6 months rate by using a formula, which is 1 under root of 1 plus r minus 1. Correct? So 1 plus r was 1 plus 10.25%, which I have written as 0.1025 under root minus 1 I have done. So if you do, you will get 0.05, which is nothing but 5%. So you have to apply this formula to find out the 6 monthly compounded rate. See, compounded every 6 months. Okay. So now you will have find out the 6 monthly rate, which is 5%. Now if you do that, you will get 11,750 as your expected return. Now this is one way of finding it out. Another way that I told you in my concept lecture was, in the first 6 months, take your opening balance. Your opening balance was 1 lakh rupees. Into you do the 6 months charging rate, which is 5%. So 5,000 rupees you earned for 1 lakh in the 6 months. Then in the second 6 months, what happened? This 1 lakh was like that only. The 1 lakh remained the same. There was no changes in that. Then you also earned, here you also earned 5,000 rupees. You also earn 5,000 rupees as your return in the first 6 months. So 6,000, oh sorry, more 5,000 you have earned, plus 49,000 you are contributing, minus 19,000 you are taking out. So you are left with a balance of, I think, so it will be 1,05,000 plus 30,000. So 1,35,000 will be the balance here. And on that 5% you are earning for the next 6 months, correct? So this will be 6,750. So if you do also same thing, 11,750 will come. So these are the two methods by which you can find out. This is what I've written in my concept notes. This is what they have followed in the ICA study material. Both are same only. Okay, so expected return we have found out. Now next you have to find out what, next you have to find out something known as actual return. So for finding out actual return, what we are going to do is we are going to make a, so we are going to make a ledger account of plan assets, like I told you. So what did I tell you? That you have to make a ledger account where you'll put opening balance is 1 lakh rupees. This is question data that I've written here. Then you made a contribution of 49,000 rupees. Then you paid out benefits of 19,000 rupees. And your closing balance will be a fair value, which is 1,50,000 rupees. Okay. Now, if all of this itself you adjust, you will get 20,000 as balancing figure. Now, the red mark ones alone, if you adjust, you will get 20,000 as your balancing figure, which is nothing but your actual return. It is nothing but your actual return. Actual return, what is the formula? It is nothing but expected return plus actuarial gain minus actuarial loss. This I told you in the concept video also. Plus or minus. Okay. So now instead of writing expected return, actuarial gain and actuarial loss, you can directly take your actual return as 20,000. But no, if you want to go in that same format, then what you can do is how much your expected return we found out. It was 11,750. Then actuarial loss was given in the question for 600 rupees. So now if you balance this ledger, you will get a balancing figure of actuarial gain, which is 8,850. So whatever balancing figure is there, the balancing figure will either be your actuarial gain or it will be your actuarial loss. So this is how. So now if you find out here, so now if you find out here, what will be your actual return? Your actual return will be expected return plus actuarial gain minus actuarial loss. So expected return is 11,750 plus actuarial gain is 8,850, which we got as balancing figure, minus this is 5, okay? Minus actuarial loss of 600 rupees. This will again come up to 11,750 plus 8850 minus 600. This will come as 20,000, which will be your actual return, which is going to be your actual return. Then you can do directly and you can ignore all the, what do you say, expected return, actual gain and actual loss. Then also the same balance will also come, or else the same ledger format that I taught you in the concept note also, if you apply, you'll get as 20,000 only. Okay, so I hope you understood how to calculate expected return and actual return. So for this, the concept notes will be very useful. Please make sure to use it. Okay. So next what we are going to see is illustration number 9. So here they are saying that there is an employee whose name is Roshan and they have joined the company XYZ Limited in the year 2001. The emoluments of Roshan as decided are 14,90,210. So annually he is going to receive this much amount. And the company has a policy that they'll give a lump sum amount of 25% of the last drawn annual salary of the employee for each completed year of service if the employee retires after a minimum completion of 5 years of service. So they are saying that if you work in our company for minimum 5 years of service, for every year of service that you have completed, we will pay you 25% of your last drawn salary. Okay, so 5 years means year 1, year 2, year 3, year 4, year 5, each year 25, 25, 25, 25, 25% you will get for every year you keep on completing, and minimum you have to complete how many years? 5 years of service you have to complete. The salary of Roshan is expected to grow at 10% per annum. So at year 0, if it is 14,90,000 to 10, then at year end 1 it will grow by 10%. Year end 2 it will grow by 10%. So like that 10% will keep on growing. Okay. Then the company has inducted Roshan that in the beginning of the year, and it is expected that he'll complete minimum 5 years before retiring. Okay. Thus he will get a 5 yearly increment. Okay. He is saying that the company is expecting that he will complete that 5 year term. What is the amount that the company should charge in the P&L account every year as a cost for defined benefit obligation? So current service cost, you remember we read something as current service cost, interest cost, etc. So like that, they are asking that every year how much he should record in the P&L account, and they are saying the discounting rate is 8% here. Okay. So first step 1, what did I tell you? Calculate that what will be the expected last drawn salary. Okay, first you have to calculate what will be your total benefit. Okay. total obligation or total benefit what you're paying going to pay to the employee. For the company it's an obligation, for the employee it's a benefit. Okay, so what is going to be a total obligation or total benefit? Find out that. Okay, so how will you find out that? What will be your last drawn salary multiplied by the benefit percentage multiplied by the number of years of service? You'll get your last drawn salary. Okay, so first you have to find out what? First you have to find out what will be the expected salary at the last expected final salary, what it will be. So final salary, last drawn salary means after 5 years, what will be your per annum salary? What will be your per annum salary after 5 years? So keep on adding 10%. So 14 lakh 90,000 to 10 plus 10% plus 10% plus 10%. So 5 years he's going to work, correct? So like that you have to keep on doing plus 10% for 5 years, because for 5 years the salary will keep on increasing. So if you do it for 5 years, then it will become 24 lakh rupees. So your last drawn salary at the year end 5, you will be drawing 24 lakh rupees as your salary. Okay, so this 20, out of this 24 lakh, how much benefit are they ready to pay you every year? 25%. And for how many years are they ready to pay you? For 5 years. So totally your benefit or your obligation will be 30 lakh rupees. This was a step one. I told you that you have to follow 7 steps. Around 7 steps were there for finding out defined benefit obligation. So first step was this. Then after that you have to find out that per annum how much are you going to charge? Per annum how much? Second step was per annum how much are you going to charge? You have to find out. So 30 lakh divided by 5 years, so 6 lakh rupees will be charged to PNL every year. Will be charged to PNL every year. So this was your second step. You find out that also. Third step was you have to find out something known as your current service cost. So 6 lakh will accrue every year for 5 years. But this is not the present value. You have to find out the present value. How will you find out the present value? First, you have to find out how many number of years are left. How many number of years are left? How many number of years are left? So first year, what 6 lakh is accruing, you're going to get it after 4 years. 1, 2, 3, 4. At the end of 5th year, you're going to get. So after 4 years, you'll get this. After 3 years, you'll get this. After 2 years, after 1 year, and 0 year. At the end itself, you'll get this. Okay. So at year end 1, the 6 lakh rupees will accrue. At year end 1, this is going to accrue, and you're going to get it at year end 5. So 4 years. 4 years is your time period to get it. 3 years is your time period to get it. 2 years is your time period. Likewise 1 year and 0 years. So this will be accrued at year end 5, and you will also get it at year end 5. So 0 time period. I hope you understood this. According to that, write your discounting factor. So first discounting factor will be 1 divided by 1 plus 0.08 to the power 4. So like that you will find out your discounting factor 0.735, 0.794. So likewise it will keep on reducing 3, 2, 1, 0, and this will become 1. So like that, first find out your first write down your year, then write down per annum how much how much defined benefit obligation is going to accrue. So it is 6 lakh, 6 lakh, 6 lakh. So it is going to be 6 lakh, 6 lakh, 6 lakh, and then find out your PV. What is your present value? Okay, so find out use that present value factor and find out your present value. So each year this much amount is going to get expensed off. This year, every year this much amount is going to get expensed off as your current service cost. So this was your calculation of current service cost. Step number 4, I told you that you have to find out interest cost. Why interest cost? Because here you have made it present value. Now to bring it to the future value, every year you have to charge interest on it. So next step number 4, what you have to do? You have to find out something known as interest cost. So interest cost also will go and get charged in your PNL account. Your current service cost will also get charged in your PNL account, correct? So year 1, 2, 3, 4, 5, and so here what you will do, you will find out you will write what your current service cost is. Year end 1 it was 4,41,000, year end 2 it was 4,76,000. So likewise until year end 5, what was your closing, your current service cost, that is your PV amount, you have to write that. On this, what will happen is every year you are going to get charge interest. So year end 1, the balance was 4,41,000. So in year 2, what will happen is, so at year end 2, what will happen? Your opening balance was 4,41,000, which got carry forward. Okay, let me erase this so it's easier for you to understand. Yes. So what happened? So your opening balance of year 2 was 4,41,000. On that you will get interest of 8% for 1 year. So 4,41,000 into 8%, you will get 35,280. Okay, so that interest you will earn on it. Plus again, you will have to charge a current service cost of 4,76,400, which is pertaining to year 2. So in every year, So every year two cost will get charged to PNL. One is your current service cost that you find out using doing PV, and second one is your interest cost, which you are going to charge on your opening balance, on which you are going to charge on your opening balance of each year. Okay, so on that you will get your interest cost. So these both will go and get charged to your PNL account. The addition of these both will go and get charged in your PNL account. So what happens? What will be a closing balance? So in opening we had 4,45,000. Then we again charged 35,218 our PNL, and then the current year service cost of 4,76,400 also we charged to PNL. So all these three after being charged to PNL, your closing balance will be 9,52,000. So on year three, what will happen? On that you will now charge cost. So it is going to be 9,52,000 opening balance. On that you will charge 8% interest, plus that current year service cost will also come. So all three together, your closing balance is going to be this much. So your closing balance of 1 year will be the opening balance of next year. So like that, if you keep on doing, at the end you will get 30,000. At the end you are going to get 30,000, which was our total benefit. See here, which was our total benefit. So if you keep on expending your current service cost and interest cost, you will arrive at your closing balance of 30,000 at the year end 5, at the year end 5. Okay, so I hope you understood this. So in this we had to only show them how much current service cost we will charge every year and how much interest cost we are going to charge every year. So in year 1 you will not have any interest cost, because at year end 1 only you find out your current service cost. So in year 1 you will not have interest cost. Your interest cost will get charged from year 2 to year 5 only. Okay, so I hope you understood this. Okay, so now let's start with our practical question. So here they say that there is a company and they have a scheme for payment of settlement allowance to the retiring employees. So whoever employees are retiring, they will pay them settlement allowance. Okay, and here they are saying that under the scheme, the retiring employees are entitled to get reimbursement of certain travel expenses that they are entitled for. Okay, and also they'll get a lump sum payment to cover the food expenses. I mean, to cover expenses on food and stay during the travel. So whenever they retire, they can claim an expense where they'll get the travel expense, food expense, and stay everything. They will get a, what do you say? They'll get as a reimbursement. Or alternatively, they have another provision that employees can claim a lump sum amount equal to the 1 month last paid on. So whatever your monthly pay is at the last, that also you can get as a lump sum payment. Fine. So like this, they have some policy. So here, what the question asks you about is that this is a settlement allowance, and it does not depend on the length of service. It depends on your travel, or it depends on your last drawn salary, and it does not depend on how much time you are going to serve in the company. Correct. So since it is not related to the length of service of the employees, it should be accounted on claim basis. So what the company is saying is, whenever the claim arises, we'll account for it. Then now we are not going to do anything about it. Is this correct? Is this contention correct? What did we read? We read in one of the question that whatever employee benefits you're going to pay to the employee, let it be medical leave, travel, or whatever it is, you have to always create a provision on it. You have to always create a provision on it. Directly on claim basis, you cannot take it up. Correct. So this is what they have said in the answer also. Yes. So settlement allowance is an employee benefit. So it is an employee defined retirement benefit or employee benefit. So here the provision is to be made every year in the accounts, accruing liability on account of settlement. So how much ever you think on estimated basis, the claim will come in the future. According to that, you have to create a provision every year. Okay. And here they are saying that you can take use of actuarial valuation to calculate the provision also. So however, the amount of provision, if it is not material, how much the provision that you have to create, if it is not material, then in such case the company can follow some other method. But if it is material, then in such case every year you have to account for a provision. You have to account a provision every year according to the estimates you have in mind. Okay, so here also there will be one line. Yes, so the contention of the company that the settlement allowance should be accounted on claim basis is not correct. Even if the company has thinks that the amount is uncertain and requires estimation, they are saying that please estimate it and write it. Don't put it on claim basis. Every year please create a provision. Okay, fine, that was it. And then we have question number 8. Question number 8, they are saying that there is an following data you have to apply for X Limited, and you have to calculate the actual return on plan assets. So actual return on plan assets, how did I tell you? Please create that ledger, plan assets. Put what is the opening balance. Opening balance is 31st March 2001, 31st March 2002. So 31st March 2001, this is the opening balance, 8 lakh rupees. What is the closing balance? 31st March 2002, 11 lakh 40,000 rupees. Employer contribution, how much you have contributed to the firm? 2.8 lakh rupees. No other information is given. So whatever the balancing figure is there, if you know, suppose usually what would happen, you have expected return, then you have actuarial gain or loss, actuarial loss, actuarial gain. So all, if all these information are missing, so you just know that your actual return is nothing but your expected return plus actuarial gain minus actuarial loss. So if all of this is missing, then directly whatever balancing figure is going to come, that will become your actual return, that will become your actual return. So here the balancing figure is how much? Okay, so here above they have written benefits paid. I think I missed it out. So here you have to take benefits paid of 2 lakh also. Okay, so if you take that, it is going to be 8 lakh of opening balance plus 2 lakh 80,000 contribution minus 2 lakh benefits paid minus your closing balance of 11 lakh 40,000. So 2 lakh 60,000 will be your actual return. 2 lakh 60,000 will be your actual return, and that is what is given in your answer. I hope eighth question is clear. So always remember when you are solving the question, if data about expected return, actual gain, actual loss is given or not given, if you can just exclude this, if you just don't write any of these, the balancing figure whatever will come will be your actual return only. Okay. Next is the fair value of plan assets of Anupam Limited was 2 lakh, and the employee benefit pension plan on 1st April 2001. Okay, so they are saying that your opening balance is 2 lakh rupees, and then on 30th September, you have paid out 25,000, there is contribution of 55,000, and then on 31st March you have a fair value of 3 lakh rupees. That means your closing balance is 3 lakh. And yes, so again expected rate of return is 10.25%. This was same like our illustration that we read. Here only one information, that two information that is missing is, there was in our sum there was an information about the present value of closing balance and as well as actuarial loss was given. So now that is not there, and then this is your sum. So this is the lower version of the illustration that we did. Let me tell you the illustration number also. So the illustration number was illustration number 7. So yes, same to that, that was your practical question number 9. Okay, so I hope you completely understood this. And yes guys, so in case if you have watched until the end, and if you found this video helpful, please make sure to like, share, and also subscribe to the channel. In case if you have any doubts, please post it in the comment box below. I'll try to clear it out. Yes, and the notes of the concept notes of this AS15 will be available on my Telegram channel, so make sure to check out that too. Thank you.